Welcome to Real Estate and Beyond, and I am here with Frank Coto, which also he goes by the name Frank the Bank, which I gotta say, genius branding, Frank.
Thank you, Chris. You know, I will be honest, there's a couple people out there like, I don't like that branding.
Oh, I love the branding.
Thank you.
It's very memorable, and that's the number one thing of branding, isn't it?
That's it.
You know, the very first time I met you, I was like, Frank the Bank, that's genius. I came back to my office and they said, you know, there was this dude there at this event, and his name was Frank the Bank. I'll never forget it. And
Dude,
there you go.
That's awesome. So funny side story is that it was an old title friend of mine who used to own insured title agency, and he called me Frank the Bank, and I hated it, right, in front of everybody. I'm like, I'm not a bank, I'm a broker. And then he died very, very sadly and very suddenly, right? And people started calling me out of the woodworks and be like, hey, you're Frank the Bank. You're Kevin's buddy, right? Frank the Bank, Frank the Bank. Next thing you know, I was Frank the Bank.
Well,
So,
I mean,
you know, it's like I'm paying homage to my buddy Kevin.
it works.
It did work, yeah, for social media especially.
Right?
So,
Right.
The wife and kids are like, come on, Frank the Bank.
They're like, oh, we're going shopping.
Yeah.
Frank the Bank.
Yeah, my daughter's like, oh, you're a bank, are you? Yeah, I was like, yes, honey, yes, for you. But I love being here. This is a great studio.
Oh, thank you.
You kind of make my studio look bad, to be honest.
I'm sorry.
You know, I know it wasn't intentional, but it's awesome. I love it in here.
We do love it. A lot of our agents are using it to shoot their own podcasts and content for social media. So it was actually one of the things that when we set up this office, we didn't have a whole lot of rooms.
Yeah.
And we were considering reserving one room to either a team or a title company. And I said, nope, we got to have a studio.
This is awesome. I think this is way better.
Thank you.
Absolutely.
All right, let's jump into our topics today. So Frank the Bank, obviously a lender.
Yes.
So we are going to talk about mortgages and lending and everything that's going on in the market.
All right.
And everything everybody needs to know about.
Well, hopefully I know something.
Well, I think you might.
Let's try it.
All right, let's start with talking about the current trends in the lending market. What are you seeing right now?
Well, I will say it like this. The lending practices over the last 12 years since our crash in 2009-10, well, I guess 14 years, it's been that long, they were way more strict than we have ever seen. And I've been in the business 24 years, right? So the good news is things are loosening up. There's more products available. You can go down to lower credit scores. We talked about it on a couple of reels together. You can do no minimum credit score for a veteran now, 500 credit score for FHA. I mean, there's bank statement programs down to the mid 550s. So things are loosening. But I always like to give this stat because people talk about, is there going to be another foreclosure crisis? And I think it's a good angle, you know, talking about where the status of lending is going. Because lending was so tight in the last 12, 14 years, we are very likely not going to have a foreclosure crisis because the loans on the books were so good. Now, when I say we're loosening up, I don't mean we're giving 100% loans, except for VA, with a 450 credit score, right? Those guys deserve it. But everybody else, they're having to put down payments down, right? So yes, there's more 100% programs. Yes, there's lower credit score programs, but we are asking for skin in the game because that's what crushed our market back in the 2000s, is that people didn't put down payments down. And we gave them loans that we shouldn't have. So I think it's great. I think the industry is headed in the right direction. I think consumer confidence is at all-time high. And I think we're going to see lower rates next year as well.
I remember there was a buyer several years ago after the crisis, and she called me and she said, are you aware of any 100% loan programs? And I remember thinking, like, are you out of your mind? Like, of course not. Like, there is no such product. Like, this is not like buying a car. And yet, here we are today with 100% programs. It's crazy to me.
But the difference, remember, Chris, the difference is before the crash, we were giving 100% financing to people with a 550 credit score, right? And adjustable rate mortgages and all these things, we were setting them up for failure. Since they brought them back, you can't get a 100% program without at least a 600 credit score at least. Or if you have, real high credit score, you can do no money down, things like that. But it's going the right direction. Skin in the game. That's important.
As far as the trends go, are you seeing any difference between the residential market and the commercial market?
So it's funny, we had a commercial broker on the radio show today, and we asked that exact question. And we are seeing a loosening of commercial guidelines as well. the commercial market, he was saying basically industrial is a very high percentage of people being in them, but our problem we're seeing on commercial a little bit now is office space is down a little bit because of the remote working situation. But overall in commercial, I would say the biggest difference and the biggest positive is that commercial is taking a page from residential. And what I mean by that is they're opening up that DSCR product, for example, the debt service coverage ratio product that is a no income verification loan for an investor. Well, now it's available for a commercial investor, and you can buy up to 29 units on a commercial multifamily property without proving your income. So is there a difference? Yes, but I think we're seeing very positive changes in commercial by expanding the product lineup. You can do lower credit scores now. It used to be with commercial, you just went to your bank and you got an SBA loan, right? Or a conventional loan, 20% down, or the SBA government loan, sign away your life. Now you have bank statement, asset only, DSCR. So it's a very exciting time in commercial, especially for commercial multifamily.
Are you seeing what I'm seeing in terms of, a couple of years ago when the fix and flip programs became really popular, and you'd see these amateur fix and flippers come to the market, and
Yes.
they were going to be millionaires. I'm seeing a lot of people shifting into commercial, thinking that that's the new golden goose, and some of them are clearly kind of dabbling in that arena. Are you seeing a lot of borrowers apply for commercial loans where they just don't have any experience in that arena and kind of getting into it?
The answer is yes. And I think that is a product of this opening of some of the residential products into commercial. What's happened is commercial, again, used to be the big bank world. Now it's turned into the small lender world. And these small lenders have national lenders, just not FDIC banks, have seen exactly what you've seen. They've seen that guy who maybe had a 4-unit residential property say, you know what, I think I should buy a 6-unit or a 10-unit. And we've seen people who are looking at the math on a 3 and 4 unit saying there's no income there. So I want to look commercial. And when you have a product that matches up with them to do that, like I was saying, up to 29 units, as far as it used to be 20, then it went to 24. This year it's at 29. What do I think next year? I think we'll probably have a 40 unit. So what does that mean? You could buy a hotel, a motel, a Holiday Inn. I did that on purpose. But you could literally get into this multifamily now that you couldn't. So I think it's a good thing. I think if you're a residential buyer, and you were talking about people with no experience, that is a whole angle to the program as well. It literally says no management experience required. And why does it say that? Because your bank loans want management experience. Mm-hmm. You can't retire from WFLA as an executive and go get into a commercial building and go with a bank loan. You can do it with one of our non-QM loans. Mm-hmm. So yeah.
Well, it's an interesting market, and like I said, a lot of people are getting into commercial that weren't in it before, which is really great.
I think they should.
Well, here's another topic that is never ending. Let's talk about interest rates and where they're going and why.
All right, so interest rates. Oh boy. How about we'll start with the difference in the Fed and the interest rate, right? Because everybody has heard over the last few months, basically like right before the election, they started dropping the Fed rate. So for you and I, if we want to just pretend to be advertisers, then we're going to tell all of our clients, yeah, look, the rates are dropping. But we would be lying because that Fed rate, which is the prime rate, is really only tied to the home equity lines of credit and your credit cards, right? It's not your 30-year fixed rate.
And an ARM. Isn't it tied to an ARM?
It can be. So believe it or not, most ARMs, adjustable rate mortgages, are tied to a totally different index than the Fed is tied to, right? They are adjustable. They are coming down. So here's a quick example. I think the prime rate was at 8.5 just a couple months ago. Now it's at 7.75. I told a friend of mine today, in the next year and a half, 2 years, it'll probably drop another 1.5, maybe 1.75, something like that. You might be at 7. So we were kind of comparing, do you want to get that adjustable rate that is at 7.75 now and may go down to 7 or 6.5, or do you just want to lock in today at 6? You know, I'm a huge fan of 30-year fixed. You know, I'm a huge fan of just covering your butt using the equity lines. But long and short of it is rates are coming down. Rates are coming down. If you're in the market to buy right now residentially, my advice would be don't pay too many points. And why would I tell you that? And it's not, it sells me out of making money, right? But I'm being an ethical guy saying, Chris, I don't want you to go spend 2 points right now. Pay a point, hedge yourself, get a good rate instead of paying 2 points to buy down now. Why? Because I'm willing to bet you're going to refinance in the next year. And why pay the points now when you can pay them down the road? Why buy down from 6.5 to 5.5 when you can buy from 6 to 4.5?
Well, here's another question. I'm a big fan of temporary buy down products because you don't lose the money if you refinance.
Bingo.
And I think that's something that most people have no understanding of at all. Can we go into that a little bit?
Yeah, and I'm going to throw a wrench into that, right? So people bring that up all the time. I am a fan of temporary buy downs as well. But there's one piece of the puzzle that people have to understand. What is a temporary buy down really? So you're selling a house to someone, and the seller is willing to give concessions so the buyer can use it for a temporary buy down. Well, let's say the seller is going to give that person, let's just say they're going to give them $12,000 in concessions. Easy math, right? Well, you could use that $12,000.
Well, 10 would be easy math.
I have a method to my madness here. I was going to say that. I'm going to do 12 for a reason, though, because let's say
in a year.
You got it. That's exactly what I'm doing. So if that temporary buy down, let's say, is a 1-year temporary buy down, what that means is you can take that $12,000 that the seller gave you in concessions, give it to the lender, right? And instead of giving you 6.5, they give you 4.5 for the first year, and then 5.5 for the second year, right? And then you're back up to the 6.5. So temporary means you're going to end up refinancing, right? Or, follow me on this, take the $12,000, take it off your closing cost. That's $12,000 you made today. So I'm going to ask you a question, Chris. If I said, hey, I'll give you $12,000 over the next 2 years by giving you $500 a month, every month, or I'll give you $12,000 today, what would you like?
I would take the $12,000 today. Thank you, Frank.
And we're sold. Sign right here.
However, the temp buy down comes into play when you don't have enough closing costs,
Sure.
when you're getting so much in concessions from the seller that you don't know what to use it for.
Great point.
And then you can either do a permanent buy down or you can do a temporary buy down, where I was going to gravitate towards the temp buy down just because of the environment where we're expecting the interest rates.
100% agree with you. And most agents don't even take the math that far to look at it. So I'm happy you said that, because that is exactly how I would tell you you're going to refi either way. Get that temporary buy down because it gives you a bigger jump on the rate. A temporary buy down gives you a whole point or two off the rate.
Well, and a lot of agents don't have the problem of having too much in seller concessions.
That is true, right?
I typically will have that problem, so I need to allocate them.
Well, it's because you negotiate well.
Thank you.
I do too. I've seen it.
All right. So here's another concept that I like and that I actually learned from you, which is buy the house, date the rate.
Oh, marry the house, date the rate?
Oh, yeah. Marry the house, date
We're going to marry. Well, buy the house, too. We should do that. Right? It's one of my favorite phrases, and basically it alludes to the fact that you and I have been in the business for a long time. We've seen the ups and downs. We know the market's turning around. We know the rates are going to come back down. Why in the heck would you not buy the house at today's prices? Because the other thing we've seen, even with all of these crazy markets you and I have been through, what have prices done? Gone up. They've gone up during COVID. They went up after COVID. They went up, with the hurricanes. If they came down, it was like 1%. The one thing we can pretty much guarantee is prices are going up. Well, we also think rates are going down. So why not marry the house, buy it at today's price, which is going to be better than tomorrow, 90% chance. And then when the rates drop, you refinance. You date the rate.
And it makes total sense. The other thing that I think that a lot of people don't really think about is they have a hunk of cash in a bank account.
Right.
Let's say it's a savings account. Inflation's not going anywhere. The value of that money is on the decline.
Correct.
No question. The value of real estate is in an incline.
Correct.
So having your money sit in a money market account, the value of which is going down, no question, versus having it in real estate, it's really a no-brainer.
Absolute no-brainer. You know math very well, so I'm going to throw out this third grade math for all of our listeners. Ready? Not for me and you, but for our awesome listeners. I say it to them like this. You have this money sitting in the bank. What's that making you, right? And let's say they throw out a number, I'm making 4% on it. I'm doing real good, which actually is pretty good if it's sitting in the bank, right? And I look at them and I said, well, if you were to put that against the house and the interest rate is 6%, What does that mean? It means you're making 6% if you put it into the house, without even talking about the appreciation of the home. So the easy math to someone on whether they should take money out of their bank and put it into real estate is, what are you making versus what are you going to pay? And then that doesn't even count the appreciation. So it's always better to take that low interest money and put it against a higher interest debt. Always. And I think it's a genius idea. I think you should invest in real estate because you're going to have the appreciation. Just look at the historical chart for 40 years. It doesn't go down. It goes up.
And that's the other thing that a lot of people don't know is that you can actually take your 401k and invest it into real estate. How does that work?
So the biggest benefit, so your 401k money is your money, right? It's sitting there. Again, we're talking about money growing. Well, okay, maybe it's making 4%, 6%, 8%, whatever. But historically, your real estate is making at least 10%. And we're not even talking about the difference in the interest rate right now. The way it works on a 401k is you can borrow the money against your 401k. They'll usually give you about 70% of it. And a lot of people don't know that their 401k has a clause that says you can use this money to buy a home and not pay taxes on it. That's what people are worried about. We're like, oh, we're going to pull the money out. Well, here's how you do it. You borrow the money against the 401k. It's a non-taxable event. And we as the underwriters don't count the payment against you because the payment is to yourself. You're borrowing your money and you're paying it back yourself. Other banks will count that payment against you. We won't. So using the 401k is one of the best ways to invest into real estate. You get tax benefits. You don't count the payment against you. And you can use up to 70% of the money.
And isn't there such a thing also as a self-directed 401k?
What? Now, why did you bring that up? I'm curious. Are you thinking private money when we're talking about that? Self-directed or buying real estate with it?
Buying real estate with it.
So that is a very high-level conversation. I love that question. We could do a whole show on that. So I'm a private money lender, and I also do some real estate investing. I like the lending side better personally at this point in my career. But what you're talking about is you can have a self-directed IRA. And literally what that means is most IRAs, you put the money with Fidelity or whoever you invest it with, and you have this dude that sits there and puts it into stocks and bonds and mutual funds and things like that. And
we all know the dude.
You know the dude. We all got the dude, right? Well, how about if you were the dude, right? Because right now, what do you do? Call them up and be like, oh, I want you to buy some S&P or buy me some Tesla or do like this, right? You're basically gambling in the stock market. That's the way you have to look at it. In real estate, you're not really gambling. You have a tangible asset. If you have a self-directed IRA through a company like Advanta, they're one of the companies here in Tampa that's local that does it, and I can always set your people up with that. They will let you buy real estate with the IRA. And think about this. If you use a self-directed IRA and it's tax deferred, like most IRAs are, the money you put in today, you don't pay taxes on until you take it out when you're at retirement age, and usually at a lower tax bracket. So it's a benefit, a long-term benefit. You can keep growing the money in the IRA by buying a house, renting it, putting that into the account. You could flip it, put that into the account. All the while you're compounding your money in your IRA. Think about the difference in the guy who buys some real estate 10 years ago and compounds it compared to the guy who put the same $100,000 into the stock market. Who's going to win?
Well, and then the poor soul who put it in a savings account.
Savings account. I know the way your face, you're like, savings account. But, Chris, that is the mentality that, especially you and I at our age, that's like what our grandparents and our parents taught us, right? Put it in the bank, be safe. The bank is not the only safe place. Real estate is safe. Now, stock market, I say put money in the stock market that you're willing to lose, right? Right. You put it in real estate, you're probably not going to lose unless you do something pretty stupid.
Well, the thing about real estate is the value can never go to zero.
Right.
Which stock can go to zero.
Oh, I've had that happen.
Oh, yes, me too.
You ever heard of Fisker?
Oh, please don't get me started.
Oh, please. Whole nother show. What not to invest in with Frank and Chris.
Also, a car not to buy with Frank and Chris.
You owned one?
Oh, yeah.
Oh.
Please.
Sorry, side subject, sorry. At least your car's worth something, my stock's not.
That's not cool. Oh my goodness. All right, well, let's go into applying for a mortgage.
So definitely gotten a lot easier over the years. What we tell people, one of two things, and most people go with the digital route. You go online, you do an application. Everything's secure these days, or you do an application over the phone. What we're going to do when you apply for a mortgage is what the question is, what do you need? What do we have to do? Well, number one, we have to look at your income, right? What does that mean? Well, if you're self-employed, I want 2 years of tax returns. Any lender who allows you to get pre-approved as a self-employed individual or someone with rental properties or things like that, and they haven't looked at your tax returns, that is not a real pre-approval letter. 100% fake. And that's what Rocket Mortgage does. That's why most agents don't like working with them, because they know you can go online and say, I make $1 million a year, and it spits out a pre-approval letter for you. So we need to look at your taxes. If you are just a teacher or a regular hourly or salary employee, I don't need your tax returns necessarily, because there's nothing really strange on them. I just want a W-2 or a pay stub. Or if you're a salary employee, I can trust you. And Chris, if you tell me you make $100,000 a year salary and I give you a pre-approval and you don't, well, who's the guy who's messing up? It's you, right? But that's all we really need. We need to talk about income, figure out how you get paid. Based on that, we're going to tell you what you need: a pay stub, a W-2, a tax return. Very simple. We want to look at your assets. We want to look and see, what do you have in the bank? Do you have enough money to close? And if we see you don't, well, then I'm going to ask you to help you and your agent partner. Where are you getting the money? Oh, grandma's going to get a tax return in April. Oh, okay. I'll pre-approve you subject to grandma's tax refund. Credit. Credit's the third thing. We are going to run a soft credit report on your client. What that means is there's no inquiry on their credit. It doesn't even show up. It doesn't hurt them. But it gives us, as the lender, enough information to have their debts to figure out what's called the debt ratio. You need to be under 50%. What that means is your total debts every month, including the new house, need to be 50% of your income that you claim, right? If that's the case, most products will approve you. And sometimes you can go a little farther than that. Sometimes you got to be a little less than that. But that's really the most important thing. Income, assets, and credit. Those are the three things. You just go online and do an app, or you tell us verbally. We like to get the information up front and do it right. I'll work with you if you don't have all the info, but remember, it's crap in, crap out, right?
Right.
Other than that, the process has gotten easier for investors and people maybe who don't have income and things like that. There's other products, so it's important to tell us what you want. I think the most important question that any banker or broker could ask somebody when working with them in the beginning is, what is your intention with the home? What are you trying to do? That answer tells us everything we need to know. Give us the application, we do the job, and we tell you in less than a day what you qualify for. But it's easy, especially with all the digital systems. Technology, to some degree, has made it very, very easy. You could do an app right here on this podcast in 5 minutes. My VP could have it ran, call you in 10 minutes and say, Chris, this is what you can do.
Well, I almost feel tempted to do that.
We should do it.
Just to see if we're hitting.
He's still working. It's possible. It really is. And that's another thing that bothers me is people go to a bank or to some other company and they say, okay, well, they said we did our app. They're going to let us know in 72 hours. And it just, listen, guys, I'm telling you right now, it takes 5 minutes to enter the data to run a credit report. It takes 5 minutes to read a credit report, 10 minutes to calculate income off a tax return. So, I was a little facetious on 10 minutes, but half an hour. Any good banker or broker. So if they're telling you longer, it's just maybe they're too busy.
Here's a question for you. This happens all the time. When you apply for a mortgage, even sometimes with a soft credit check, your phone starts to blow up. How do you get around that? That is a $1 billion question.
That is called trigger leads. And what's going on, it is the bane of our existence. Thank God it's only been happening in the last 2 years out of my 24-year career. Guys, I'm going to tell you how it works. Is when you have your credit ran, and I'll tell you how we get around it in just a second. When you have your credit ran on a hard credit pull, which shows up as an inquiry, that's usually how it happens. TransUnion, Equifax, and Experian, the three repositories that run our credit here in this country, which is a total monopoly, by the way, they sell your data. A lot of bankers and brokers say, oh, well, here's what you do. You don't put the phone number on the credit. You don't put their email address on the credit. So then they don't know. Guys, they have your data. Every credit agency has your data. Unless you just turned 18 and you've never applied for anything anywhere, never put your phone number, not even on your Google account or anything, they have your data. So there's nothing we can do as a banker or broker to prevent them from doing it except this. Lincoln Lending's procedure, by the way, I own Lincoln Lending. The procedure is we run a soft credit on 2 bureaus. It is not supposed to trigger the trigger leads, and 99% of the time it doesn't, right? Because they don't know that there's an inquiry. We then opt you out. So this is the key to your consumer. You go to optoutprescreen.com. You can do it. Consumers can do it. We do it for them. So our procedure is application, run the soft credit, optoutprescreen.com. I put in your information. 5 business days later, they are no longer allowed to contact you. You have been put essentially on the do not call list for credit trigger leads. So now you go find your home and it's time to actually go into underwriting. That's when we do the hard credit inquiry, where we run all 3 bureaus. And Chris, you won't get the phone calls.
That is amazing, because you would not believe how many people are super angry when their phone starts to blow up.
It ruins the experience.
And also what's kind of interesting is that they'll call you and they'll impersonate your lender.
Oh my God. That just happened on Monday, yesterday.
Yeah.
They literally lied and said they worked. So they must know, they must sell the data, and the data must say who ran the report. Mm-hmm. It's funny. I tried to open a credit agency to get around this. And that's where I found out there's like a Gestapo. You can't even do it. They have a monopoly, and they make the margins so slim to these reporting agencies that broker these out. Nobody wants to do it. And I was just going to do it to avoid the trigger leads for my clients.
Yeah.
And
well, you're one of the few lenders who has a system to try to avoid the outcome of the thousands of calls that will essentially happen after that.
It'll ruin your customer's experience, but even worse, we lose customers. Because they
think that you sold their data.
Of course. And it creates competition, right?
Well, and then the other workaround that I've heard of is in the application, you put $1 as the amount that you are looking for.
Were you the one who told me that? I think you were the one who told me that. I'm going to post that, actually. I'm stealing that. The reason that can work,
is because nobody wants to buy the data for somebody who is looking for such low credit.
Bingo. Yeah. So what happens is they sell these leads, and the lead shows up as $1 lead. Now, I will tell you from experience, I think they're wising up to that.
Are they?
And you know what I found out? Because we have the access to buy the leads as well, which we haven't bought it. I don't want to spend the money and give these guys the money, right? They are now selling them as bulk leads. Oh. So they've figured it out. So all they've done is put them, you get 10 for 1. And they know that there's gold in them, their hills.
Oh, goodness.
Yeah. So the only way to do it, guys, prescreenoptout.com. We do it for you. And that's the only way to truly avoid it.
I like it. That makes for a better experience.
Yeah, that's competition.
All right. I want to talk a little bit about common mistakes that borrowers or home buyers make during the escrow that will actually end up tanking the entire deal.
So the biggest one, they go and buy stuff. Right?
A car.
They finance cars. We had a client. This is a true story from yesterday. The realtor texts the client with us copied yesterday morning, just checking in, saying how you're doing. Hey, how was your Thanksgiving weekend? Blah blah blah. It was a engaged couple, and the bride to be now. She texts back, oh my gosh, it was the greatest Thanksgiving ever. We got engaged. Gary surprised me. He gave me a beautiful ring, blah, blah, blah. So when we heard that, Bill picks up the phone, one of my VPs, and calls the man and says, hey, I know this is very awkward for me to ask you this question, but by chance did you finance that ring? And he did, to the tune of $15,000. It messed up his debt ratio. And it was a wonderful, now of course we didn't put the wife to be on the phone and talk about that. Side note on what the agent said. But long story short, that could have completely screwed up his loan. Luckily, there were some debts that he could pay off to lower the amount. But that is the number one mistake that buyers make. They go buy things. And when you buy things, 2 things happen. It's not just your debt ratio that gets affected. It's your credit score, right? You finance something big like a car, your score's probably going to drop 50 points, at least even if it's temporarily. Well, if that's right in the middle of your loan transaction, you might not be eligible now for that loan product. Or best case scenario, you might get a higher rate because your score went down. Not to mention your debt ratio gets out of whack because you have more debt now.
And even the intelligent buyers will sometimes fall into this trap where I had a client once who was buying an investment property and it needed a full gut job.
Yeah.
So, they're thinking they're going to get ahead of the game. They go to a kitchen store to get the layout and the design for the new kitchen.
Yeah.
And so lo and behold, they're having a sale. And so, they're like, well, maybe if we pull the trigger on it today before closing, we can get this awesome deal on this kitchen.
Yep.
Why not? We're only a couple of days out. And luckily they called me and I'm like, no, do not do the financing.
Oh, they actually called you before? Oh.
Well, they were so excited about the kitchen. They were verifying some data that had to do with the size or something.
Oh, so it wasn't, they were like, hey, is this okay?
No.
It was more like, hey, guess what we're doing?
Yeah.
Yeah, that's usually how they go.
And so we caught it, but that would have, I mean, it was a $50,000 purchase, maybe even close to 100, but it would have tanked their
debt ratio.
Their debt ratio for sure.
100%. And then have fun explaining to the underwriter that you're not going to put a kitchen in.
Oh, yeah.
Yeah, because they can't unsee what they've seen. Now at Lincoln Lending Group. Probably shouldn't say that, but we can unsee because we can move underwriters. Right. But once an underwriter sees something, you can't unsee it. So it's the buying things, it's the taking out credit. That's the most important thing. Another thing people don't know, and this is probably what killed your deal, is they do a credit check. Most banks and brokers have to do a last minute credit check before you close. And the whole intention of that is to see if you took out more debt. Mm-hmm. And how do they find out? It doesn't even have, like, the guy at Home Depot could say, well, this won't hit your credit for a month. But guess what will?
The credit pull.
Thank you. The inquiry.
Yeah.
And when it says Home Depot or Nissan, guess what the underwriter's asking?
Did you buy something?
You're exactly right. So you're either committing mortgage fraud and saying no.
Don't commit mortgage fraud.
Don't do
it's
that.
It's a bad idea.
Bad. Or just tell the truth.
Yeah.
Or don't buy anything. Just wait.
How about just wait until closing and then
please,
go?
Please just wait.
Let's talk about reverse mortgages.
Ooh. How'd you know that's my favorite?
Well, I've seen a couple of your posts about reverse mortgages. Now, let me just say that
you first.
A lot of people, including myself, have heard that reverse mortgages have a kind of a bad rep. And it used to be that people would, even just the mention of a reverse mortgage was
They'd cringe.
They'd cringe and you'd tell them to run. But the world has changed, especially around reverse mortgages. So I wanted to hear your take on what the new world looks like for reverse mortgages.
The new world. I'm going to call it the post-Tom Selleck world. You've seen.
Oh, but the mustaches were so cool.
Dude, I was trying to get me to shave the beard to leave the mustache because I've been joking around. I've been trying to make myself into the Tom Selleck of Tampa. Not for looks, and I do want a Ferrari. But no, it's Chris, you're 100% right. I just did a little event this morning with about 250 seniors, and they all came up to the little booth. And I have this big banner that says the truth about reverse mortgages. And let me tell you, the faces they make are hilarious. You know, the older side of the generation, they don't hold back. You know, and they're just like, this is ridiculous. Here's the thing. In reverse mortgages, it has a terrible stigma because people really did lose their homes back in the day. I did a reverse mortgage for my own grandma when she was 83. She lived to be 93. It was the perfect scenario of taking advantage of the equity in her home. I'll talk more about her in a second, but the reason people hate the reverse mortgage, they have the cringe, is because they feel like they're going to lose their home. They think when you do a reverse mortgage, you give your home to the bank. A lady walked up today and said, I don't want to do this. I'm not giving my house to the bank. Farthest from the truth. It is still your home. Nobody owns it but you. Nobody's on title but you. And if the loan, even if the house is underwater when you pass away, meaning you have no equity because you've outlived all of the money in the house and the mortgage, you can't get kicked out. But when you're gone, all of the money you've saved up still goes to your heirs. There is no recourse. They don't go after them. And they actually allow the family to buy the house at 5% under the appraised value, regardless of the equity position of the house. The other thing about not losing your home is that since 2014, it is impossible to lose your home on a reverse mortgage. Well, unless you don't pay your taxes. Let's put it that way. Here's how. It used to be you could put the loan in grandma or grandpa's name. Just like a lot of people do. They put the loan in the husband's name or the wife's name or whatever and leave the other credit alone for whatever reason, right? Back in the day when they allowed this before 2014, let's say grandpa put the loan in his name and he passed away before grandma and the house had no equity when he passed away, grandma could have lost her house. And it happened. And you know how the bad news travels faster than good news, right? Mm-hmm. Well, that bad news got around to everybody. So we got a big negative stigma. You have a few senior citizens losing their homes in your community. Everybody's hearing about it. And well, how did they lose their home? They did a reverse mortgage with Johnny. Johnny took their home. You know what I mean? Well, I'm not Johnny. Anyway, the new rule since 2014 is both of them have to be on the mortgage. That's why nobody will ever lose their home again. As long as they maintain their taxes and insurance, really just taxes, they will never lose their home. I love the reverse mortgage product. You can get cash out. You can get an equity line of credit. You can get a monthly annuity for the rest of your life. You can wipe out your mortgage payment. You can do one of all or all of one, whatever you like. You can do all 4 options. I can't say, oh, here's another, I can talk for hours on this. I won't, I promise. We're doing a reverse mortgage for someone right now, a 90-year-old woman, 89, in foreclosure. Her house is going for tax deed sale or whatever you call it, the courthouse sale next month. We're going to close it at the end of this month. And she's going to save her house. And she had a ton of equity, but she just didn't make her mortgage payment. Her husband died. She couldn't make the payment. She didn't know what to do. She didn't want to sell it. It had been in her house for 60 years. And she was just going to sit there until they kicked her out. And she met one of my guys, and we're doing a reverse mortgage for her. Getting her a new roof, new screen, getting her out of foreclosure. So a reverse mortgage can be done regardless of your credit, your income, your assets. All you need is age and yeah, I wasn't going to say it like that, but all you need is the age and equity. That's all it is.
And what is the age limit?
So common is 62. However, there's a little known product, a conventional loan product at 55. So
I'm almost there.
Yeah, no, you're not. Well, but you will never qualify for it. No, you would. It's age and equity. So if you're 55, they're going to probably give you 25% loan to value, right? But the lady I met this morning at the show, she was 89. We ran her numbers. They'll give her 78% of the value of her house. And it's kind of sad to say why. And I even told the lady, I go, because they think you have one foot in the grave. So they're basically like, and she's like, well, the joke's on them. I'm like, she was a spry person too. But anyway, yeah, reverse mortgage is great. Reverseguru.com.
Do they go on like social media to see how fit they are at 89?
I think she would have. I'm telling you, she did not look over 70. Like, this woman blew my mind. When she said 89, I literally was like, what did you say? She was like 80. I was like, I just want to make sure I heard you right. But I created this website, very senior citizen friendly, reverseguru.com. That's the website, reverseguru.com. It's a 1-page website, 3 videos, 10 frequently asked questions. Answers everything. I really appreciate you bringing up the reverse mortgage because it's the one product that people just need to hear that it's okay, especially now. Lots of baby boomers, inflation. It's time to use your equity.
Yeah. And you were telling me that your own grandmother did this program as well.
Yeah, so Gladys Coto rolled cigars for Have a Tampa for 45 years. My grandfather was a real estate agent, actually, and he always, as with most real estate agents, they move and shake until the day they die, right? It's probably what kills us. But he left my grandma with a $40,000 mortgage when he passed away, and when she was 80. And she was really struggling paying her bills. She was getting like $1,200 a month Social Security, had a $400 mortgage payment, had a ton of equity in this house, but didn't want to move out of her house she'd been in for 70 years, right? We did this reverse mortgage for her. She got all the benefits. She got $25,000 cash at closing. She got a $26,000 home equity line of credit that she could use after 12 months. She got $500 a month for the rest of her life, and she got rid of the $400 payment. So what did she really get? She got $900 more per month because she has no mortgage payment anymore, and she got the $500. So her income almost doubled overnight, and she had $50,000 at her finger's tip. She lost her leg the year after, had to get a prosthesis, had to get scooters, had to get the house reformulated for handicapped, individuals and things like that. She had the money for that. She started going on cruises with her friends. Crazy part is she lived 10 years. She saved money. And when she passed away, it was one of those situations where the house was underwater. The value had gone down, the balance had gone up, and she actually left money to the kids and the grandkids. And the bank couldn't touch the money. It was amazing. A really, really cool story. Now, had it been today, I would have exercised the other option to buy the family home. But it was done prior to 2014. And those are the 2 rules they changed in 14. Grandma and grandpa both have to be on the mortgage together, or mom and dad. And you don't get the option to buy the house at 5% under value prior to 2014. Now you do. So I literally, this is the one mortgage product, probably besides the VA loan, that I can say is a perfect loan product.
I can't wait to be that old.
No, God.
Let's do it.
By the way, you can do them for purchases. For all your real estate agents out there, if you have somebody coming from New York, Chicago, California, and got all this cash, and they're over 62, they can put half the money down instead of all of it and get into a reverse mortgage and have no payment for the rest of their life on the house that you sell them. And then they can invest the rest in Fisker. No, don't do that.
Oh, goodness. Let's talk a little bit about the seller paid closing costs and how that all works in the mortgage world.
Seller paid closing costs. So, as you do with every client that I've ever seen that you work with, you negotiate closing costs from the seller. And essentially, you and your team can negotiate enough money, which is usually either 3, 4, or 6%, that is based on the purchase price that gets used to cover all the buyer's closing costs. So the biggest benefit to your buyer, or to the buyers listening today, is you could qualify for one of our 100% programs. What that means is no down payment. So you could do conventional, FHA, VA, or USDA. It's all of them, right? Decent credit, 600 score, you can get 100% financing. Then you have to pay closing costs. So Chris goes in and negotiates with the seller to give you $10,000, $15,000 for closing costs. And that's what we were talking about earlier with the interest rates. You guys are so good at negotiating, a lot of times you negotiate more than the closing costs. Mm-hmm. And when you do, we use that for that temporary interest rate buy down. So I would recommend getting closing costs on all your deals from your seller.
Right now, the market is favorable for that, and it really does depend on the market. So when the market is really hot, you can't get any of that.
Right.
But right now, a lot of sellers are paying for a lot of
that. Goes back to my favorite phrase: marry the house, date the rate. Buy now. Buy with Realty One now, and then we can refinance with Lincoln Lending later.
All right. Well, I will let you, in conclusion, do your little spiel about Lincoln Lending.
Oh, okay. It's my favorite thing. So thanks, Chris. It's been great doing the podcast in the studio that is prettier than mine. Thank you. Been in business 24 years right here in Tampa Bay. Founded this company just over 20 years ago. We are outside of West Chase, have a few different branches. I pride myself on the fact that we don't charge any junk fees. And my favorite thing is we don't charge app fees either. So if you want to come and get a quote from us, I'm not even going to ask for an application. You or your agents or your partners can send me a quote from another lender anytime. Tell us the credit score the other lender ran. We'll give you a competing estimate. See if we can beat it without asking for an app. And if we can, we'll ask for your business. Go to 813mortgage.com or contactfrankthebank.com or reverseguru.com. All three get to the info you want. My favorite, contactfrankthebank.com, and I'll call you personally. Thanks, Chris.
Thank you, Frank.
Yes.
That was awesome. Thank you so much for being on the show today, and I look forward to working with you.
Yes, you too.
All right.
Bye.